Okay, Victor, let's just start. They will join, and when they join, we can recap if we have time. Now, we're looking today at audit finalization and reporting. Um, Before we look today, let's just do a recap of what we did last week. Last week, we've been looking at substantive procedures, and we've looked at substantive procedures as regards all the line items of the financial statement. Now, one thing about substantive procedures are those procedures that the auditor will carry out to test and confirm and detect any material misstatement in the financial statement. And I remember that last week I gave an assignment that guys should go and find out what is financial statement assertions. Now, these are management basis for preparing the financial statement. So for every line item you see in the financial statement, there is a underlying management basis or representation for preparing those line items. Take, for instance, inventory. One of the financial statement assertion around inventory is that the inventory exists. So it's called existence. That this inventory that we put a certain figure for in the financial statement, they are actually there if you checked it. So what the auditor wants to do is to confirm those financial statement assertions. We have about 7 or 8 of them. Existence is one of the financial statement assertion. Occurrence, that the transaction has occurred. Now, financial statement transaction can either be on the line item of the statement of financial position or the income statement. Now, these assertions want to confirm that these are the assertions that management used to prepare financial statement. So, as an auditor, external auditor, the external auditor wants to test all those assertions, whether they are
Sorry, sir.
so. Hello.
Yeah, I'm with you. He said it can be on the line item of, he mentioned two things.
So I said that the financial statement assertion can either be for the line item of statement of financial position or the statement of profit or loss. So
Oh,
those financial statement assertion, they applies to your statement of financial position and they also applies to your income statement. So take for instance the transaction in the income statement. One of the assertion is that cutoff, that the transactions are recorded in the appropriate period. One of the assertion is correctness and completeness, that all the transactions that have occurred have been recorded. There is accuracy. If a statement of financial position, one of the assertion is valuation. So if you take a PPE, for instance, the state financial statement assertion is saying that this PPE has been valued accordingly in line with standard. And inventory has the appropriate valuation for it. So the auditor is trying to confirm whether the management has done the right thing by whether their position on those line items are in line with what financial statement assertion should be. So we looked at all of that. Now, the way the auditor will go about confirming those financial statement assertions around the line items in the financial statement, one of the ways is through substantive procedures. Now, this is all last week and the week before. Substantive procedures are those procedures the auditor will carry out to test for material misstatement, whether there is material misstatement in the financial statement. So, one of the things the auditor will do, which we did talk about last week, is that he will first look at the principal risk of misstatement. So if you take a current asset, for instance, what are the principal risk of misstatement around current asset? Be it your receivables, your inventory, your cash and bank balances. What are the principal risks surrounding all of this? Then after identifying the principal risk, it can then carry out a substantive procedure. The same thing for current liability, your trade payables, your accrual, your provisions. What are the principal risks around this current asset and current liability? Then you will carry out the substantive procedure. Now, one thing I will speak here is that please go back and look at the principal risk around each of these categories of financial statement, be it the asset, whether it's non-current or current asset, then the appropriate substantive procedures that follow. Once you can put that and know that, Any questions around this, you'll be able to answer it. So welcome on board Sunday. We are just going over last week. Now, this week, what we are looking at is audit finalization and reporting. Now, we are coming gradually to the end of this class. We are coming gradually to the end of the whole preparation for this exam. Now, I understand that the exam is in May, but what we are trying to do in equity is that we finish on time so that students can do revision. We also, if we have time, can do revision with them. And you know, when students receive lecture almost to the exam time, it seems like an overload of information and they don't have time to go by. So we've decided that this diet, we want to see how far we can quickly finish, give students time to go back and look at all the topics we've treated, read it. It's one thing to be attending lectures, it's another thing to read what you've been. So what we are looking at today, and this will be the last topic I'll be taking you guys for this diet, audit finalization and reporting. After all we've been looking at, the other lecturer will still come around next week anyway. After all we've been looking at, you know, I've said it at the beginning of this class that audits and assurance is in the context of the external auditor. However, some of the concepts and the principles we will discuss or we are discussing applies also to internal audit, but the focus is on external audit. Now, when the external auditors have come in, carry out the audit, obtain audit evidence, carry out sampling procedure. Initially, we have started with obtaining the engagement, prepare letter of engagement, carry out a risk assessment, carry out an assessment of the internal control system, then do the audit planning, apply the appropriate audit approach, get the audit evidence. After all of this is the stage that the audit is coming to close. So the auditors have obtained enough evidence, they've carried out the appropriate audit approach, they've done all we've been talking about, they've done substantive procedures where necessary, they've even applied risk assessment in some certain area. Now, the audit is coming to close. So what we want to focus today is, what are the things that the auditors should do? What are those standards that speaks to closing an audit? How would the auditor prepare his audit report? What are the expectations around audit report? What standard speaks to audit report? What are those things that he will do that will help him in preparing his audit report? And don't forget, the audit itself is not over until the audit report has been submitted and approved by shareholders. So, and it's in the audit report that the auditor will express his opinion whether the financial statement has been prepared in line with applicable financial framework, whether the financial statement in all material aspects is free from material misstatement, whether the financial statement is a true and fair view, shows a true and fair view. Now, these are where the auditor is going to express that opinion. So it's at this stage, and before it comes to expressing the opinion, there are some expectations, there are some things that the audit standard speaks to. So we'll start with the first audit standard that the auditor needs to, that we need to take note of, which is testable in your syllabus. That's the first one is ISA 580, written representations. Now, what are written representations? What was the objective of ISA 580 around written representations? Written representations are simply those written statements by management to provide and confirm, to provide comfort or confirm what audit evidence the auditor has. In the course of the auditor will be meeting with management, and be audit evidence. There are instances when in the meeting with management, there will be some verbal confirmation from his inquiry. I've seen this. How do you guys operate this? What is the purpose of this? The management will be giving some clarity, some verbal, some in written documentation. But at the end, towards the end, the auditor needs to obtain a written statement. That is, he needs to get documentation backing all the audit evidence or some things that he needs clarity on. So if he has obtained an audit evidence here, he wants a confirmation of the management that, oh, this thing is so. So, and it's not just verbal, it has to be a written statement. Maybe there are some areas that he needs clarity on. It might not even be audit evidence. He just needs some kind of enlightenment or why is this like this? Now, the management might have told the auditor verbally that that's how we do this. So at this stage of finalizing the audit, the auditor needs to obtain a written statement. And that's what written representation is about. Now, the objective of the standard around written representation is that, one, the auditor needs to obtain written representation from management that management has fulfilled its responsibility as regards financial statement and the audit. At the beginning of the audit, there will be letter of engagement stating the purpose of the audit plan, the scope, the materiality, the responsibility of the auditor, as well as the responsibility of the management. Now, the responsibility of management is clear and is clear. Management is responsible for preparing financial statements. Management is responsible for providing books of record. Now, when the auditor finishes or is rounding up the audit, he also needs to get a written statement, in quote, written representation from management that they have fulfilled their responsibility when it comes to the financial statement and the audit. That means they are saying that, we have done all that we need to do when it comes to preparation of this financial statement. And that when it comes to this audit, we have done our part. So the auditor must obtain that written representation. And that's what the standard says. Then the second thing the standard is saying is that written representation should be obtained where appropriate to support audit evidence. Now, it's one thing for the auditor to obtain audit evidence, but there are some cases, some instances that the audit evidence needs another higher level of backing. So in situations where the audit evidence needs management confirmation or management to also say that, okay, this audit evidence is fine or they agree, the standard is saying that the auditor should obtain written representation where appropriate to support audit evidence. So that's the second objective of the written representation standard. Now, you don't need to memorize this, you just need to understand what written representation is and what the objective of the standard around it. The objective of the standard is just to enable the auditor to know that I need to obtain written representation from management that they have fulfilled their responsibility when it comes to financial statement and the audit. And where appropriate, I need to obtain written representation to support audit evidence. Then the third objective is that the standard says that the auditors or management should respond appropriately. The auditor should respond appropriately to written representation provided by management, or if management refuses to provide written representation where requested. So it's one thing for management to provide written representation. There are some written representations that the statement of the management would demand that the auditor responds. So take for instance, management have prepared inventory valuation, blah, 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 and the basis of valuation has been on cost. But during the course of the audit, the auditor find out that we all know that inventory, according to the standard, should be valued at lower of cost or net realizable value. So it's not just that you value inventory based on cost. You must have considered which of the two is lower. Is it NRV or cost? So if NRV is lower, you value it at NRV. And if cost is lower, you value at cost. But in this case, just an hypothetical case, management has valued inventory at cost and without consideration for NRV. And they just say, we value our inventory at cost and blah, blah, blah. And they provide that written representation. Now, that necessitates that the auditor should respond that, even though you provide this in your statement that you value inventory at cost, however, in the course of the audit, which is in line with standard, that inventory should be valued at lower of cost or and net realizable value, we've obtained enough evidence to show that the actual valuation that should have been for inventory should have been at NRV. And that's what this particular objective is saying, that where appropriate, the auditor should respond to the written representation. So it's not just that they provide written representation. What is it saying? Does it necessitate a response from the auditor? Then there are situations that management might refuse to provide written representation. They also provide that the auditor should respond in such situation. So this is the whole essence of written representation. There is a guide to it. Now, what we are saying for those who are just joining the class is that the topic we're looking today is audit finalization and reporting. And this is the stage where the audit is drawing to a close. The auditor is trying to wrap up his work. The auditor have obtained audit evidence. The auditor has carried out the audit using the appropriate audit approach or strategy. At the beginning of the auditor have given a letter of engagement signed. The clear direction of the audit has been stated. The audit plan scope. The auditor has done all he needs to do, but he's not just going to wrap up the audit just like that. He needs to do some things which will help him in closing out the audit. And that's what we're looking at today. Finish the last stage of the audit. Audit is usually in three stages. There is the planning stage, there is the actual audit stage where you carry out the audit itself. Then there is the audit finalization, the closing stage, which is what we're looking at. And I said that in looking at this stage, there are standards that speaks to this last part of the audit. What is it? What the auditors should do? You know, the audit work is a very highly regulated work, and is a work that is guided by standard, just like in your accounting, your IAS. So there are some specific standard that speaks to how the audit should be closed. What are the expectations around this? So the first standard we are looking at is written representation, which is ISA 580. ISA 580 is on written representation. And written representation is a written statement from management to provide or confirm certain matter, is provide support to some audit evidence or provide clarity on some certain matter. What do we mean by this? The auditor have obtained some audit evidence. Sometimes the auditor will need a statement from management on that audit evidence he has obtained. So it needs written representation says that this is what the auditor should do. It's not a verbal statement. There should be a documentation. And there are three main objectives of written representation. One, that there should be a written representation for management that management has fulfilled its responsibility when it comes to financial statement and the audit. The second one is that written representation should be provided where appropriate for audit evidence. Hello, is anybody asking a question? Adisha, please mute your mic.
Sorry, sir. Thank you.
No problem. So we said there are three main objectives of written representation. The first one is that management is saying that they have fulfilled their responsibility when it comes in respect of the financial statement and the audit. So there will be a written statement, a document signed off by the management that they have fulfilled their responsibility when it comes to preparation of financial statement and the audit in question. Then the second one is that there are some audit evidence that require written statement from management. Then the third one is that where appropriate, the auditor needs to respond to the written statement or the written representation. So written representation is not just for you to take it and put it in the audit file. Some might necessitate the response from the auditor. Now, another name that we usually hear in practice about written representation is management letter or management representation rather. So this is where the management will give their own confirmation on the issues raised by the auditor. Oh, this and this, we are using certain accounting policies for certain reasons. The auditor might be asking, oh, where did you change? Why did you change your accounting policy? There will be a statement that says, we did this based on this and that. Now, what is the form, or how does written representation looks like? The thing is that written representation is usually drafted by auditor. Now, listen carefully to what I'm saying. Written representation is usually drafted by auditor and to management, but it's management that will sign it off. What are we saying? The letter ideally, based on standard, is that it should come from management. That this issue you are raising, this is our stand on it. This is the explanation for it. The management will sign it off. So that's the standard. That's the main idea. But there are some written representation that sometimes the auditor will draft it himself and give to management to sign off. So management can either sign it off or add some few clauses to it, but it will be drafted by auditor. Now you may ask, why is it that the auditor is drafting the written representation for management if management is the one making the stand? The reason is that the auditor is the one seeking clarity. The auditor is the one raising questions and wants a statement from management. So most time, management doesn't even know the area the auditor is asking question for. So it's the auditor that will draft it that, the inventory has been prepared in line with IAS and we value inventory at cost, blah, blah, blah. So if management has a contrary view, that's when they will now edit. But usually, it's drafted by auditor, signed off by management. He will draft it as if he's addressing him to himself. That's the form. He will draft the letter as if he's writing to himself as the auditor, but the management will go through it, agree with it, and then sign it up. Now, the letter is usually not different. It's written in simple statement. Then there are some key things that will be in the letter. Now, a written representation will contain these following key things. If you have your data, you can take note, although it's in the text. I believe all of us have the text. The text is on the WhatsApp group in case you don't have it. But let me see if I can scroll down and see where it's stated some of the content of the written representation. Okay. If we have the test, we can just go through. So the first thing that a written representation should have is that the written representation relates to the audit of the client company. So when a written representation letter is drafted, either by auditor or is coming straight from the management, what we want to see, the major content or the letter should be about the audit of the client company. So when you see a written representation, it's not talking about anything as a project. It has to be for that audit. So written representation relates to the audit that is being carried out. It's not speaking about what the company is selling or the issue the company have with shareholder. No, the focus and the content should speak to the audit of the client. So when you see a written representation, is specifically for that particular audit, and that's the form. In case you're in an exam, you might have to draft a written representation. I don't know if you check your ICAN pack, there is a format of written representation there. You can just go by. Then the second thing, like I said, which is part of the objective, the management of the entity must take their responsibility for preparing financial statement, and that the financial statement give a true and fair view and is free from material misstatement. So one of the key things in written representation is that the management responsibility for preparation of financial statement must be stated. So in that written representation, whether it's trying to give clarity for expenses, it's trying to give clarity on any audit evidence that the auditor is asking for support or any issue at all, there should be a statement that that covers the responsibility of management for preparing financial statement. Is a key part of written representation because the responsibility of management is for preparation of financial statement. It's not the responsibility of the external auditor. It's not the responsibility of an outsourced company. There are companies that outsource the management account, financial statement preparation. Is the responsibility of management. So whether it's outsourced, whether it's done by an accounting firm, management is responsible for it, and it's not the work of the auditor. So a statement stating that will be in the written representation. Then the various assumptions that management have made when it comes to accounting estimate and fair value estimation will be stated there. Now, you know that financial statement has accounting estimate. Most of the figures in the financial statement are based on accounting estimate. One accounting estimate is depreciation. We are depreciating the straight line method for the next useful life of 5 years. You'll be depreciating at 20%. You are estimating that the asset should lose this certain value yearly. So the basis of make those accounting estimates, and for fair value, there are some line item around investment, financial instrument that comes with fair value estimation. So management has to state whichever one they are using. I know in IFRS 9, there is fair value to profit based on profit and loss. So all those assumptions will be stated, and they have to be reasonable. So that will be stated in the written representation. Now, for this written representation can come in different form, but there is one that will be provided at the end of the audit that will cover all of this. There are some smaller written representations, some small documentation that the auditor will need to seek for clarity or some audit evidence. But this particular one is like a one letter that will contain all of this, that will be issued at the end of the audit, speaking to the audit, the responsibility of management for preparing financial statement, the assumptions around accounting estimates, related party transactions have been disclosed, the all events after reporting period have either been adjusted, the ones that are non-adjusting, the effect of incorrect misstatement. There are some misstatement that are immaterial. Management will state why they've not corrected. Then all of this will be stated in that written representation. The transactions have been recorded and included in financial statement. That's financial statement assertions. Then all this, the management have also disclosed all information to the auditor. All of these things must be in the written representation. Now, if you look at this written representation, it gives the auditor a reason for that, in carrying out our audit, this is the stance of the management. We will be looking at ISA 450 very shortly. There are some, based on the materiality that is set, there are some misstatement that the auditor will discover in the course of the audit. Management will also state the reason for all those misstatements, whether they are trivial, whether they are due to omission. Even if there are cases of fraud, management will state what they've done. Now, if you look at in your text, management will disclose all known instances of non-compliance with law and regulation that are relevant to the preparation of finance. So whatever the auditor needs to know when it comes to preparation of financial statement will be stated in that written representation. Now, you see that this written representation is a very, very important document and integral to the audit and for the auditor. Now, what happens if management refuses to provide this written representation? There are situations that management will say, we are not providing this letter you're asking for. The letter is drafted usually by auditor and it wants the management to sign it up. And after they've gone through it, so you want us to say, we've declared this, we've done that, the auditors have been provided. And if they refuses to provide it or to sign it up, what should the auditor do? Should the auditor just say, oh, I'm packing my bag and go? No. The first thing the auditor needs to do is to have a meeting with the management to discuss the matter with the management on why they don't want to provide the written representation. And when we talk about management here, is higher level of management or those charged with governance. Those charged with governance are usually audit committee, board of directors, and shareholder. So if management says we are not providing this written representation, the auditor is required, before doing anything, to discuss the matter with management, an appropriate higher level of management, or those charged with governance, that why don't you want to provide this? What's the issue? Now, he also needs to reevaluate the integrity of the management and reconsider the impact on other representation and audit evidence. What are we saying here? If management says we are not providing written representation, the auditor then needs to look at this management that says they don't want to give written representation. Is it that they have anything they are hiding? It needs to reevaluate the integrity of the management. You know, at this stage, the audit has finished. It's rounding up. He just need that letter to like a part of audit evidence, because written representation in itself can serve as audit evidence. Now, if management is saying they are not giving that letter, the auditor needs to start assessing and evaluating the integrity of the management. Is it that they have something they are hiding? And in evaluating it, now needs to start looking at the audit evidence he has obtained. Could it be that there is a risk of material misstatement somewhere? All this audit evidence I've obtained, because we said that one of the objectives of ISA 580 is that where appropriate, written representation should serve as a support to audit evidence. So if management said they are not giving the written representation, then it causes to question the audit evidence that will be obtained by the auditor. So the auditor needs to evaluate that. Then lastly, after discussing the matter with management and evaluating whether the management integrity is intact or there is question here and there or not, the next thing the auditor should do is to take appropriate action, including considering the effect on his audit report. What do we mean? The auditor will now look at, okay, if I don't obtain this written representation, maybe it will have effect on the audit report I'm preparing, whereby I might have to give a modified report. We'll still look at what we mean by modified report. Or maybe I will have to put a disclaimer in the audit report. So the action could mean, or I might even have to take it further and seek counsel from the professional body. So usually, if written representation are not provided, it will have impact on the audit report. When we get to, though not in this class, in advance, there are different types of audit report. We have two major types, unmodified and modified audit report. But for modified audit report, which is what is called a qualified report, there are different levels to it. There is a disclaimer opinion, there is an adverse opinion. So the auditor will now consider, if I don't obtain this written representation, does it mean that what effect is it going to have on the audit report vis-a-vis his opinion? Could he be issuing a disclaimer opinion? Or if he has considered the management's integrity and the audit evidence, based on the fact that the management is not ready to give written representation, is more like a support document to the audit evidence. So if the management is not giving it, it could mean that there are issues in the financial statement. So the auditor might even choose to give an adverse opinion on the audit report. Now, these are what you need to know. So when you're doing your review, know what written representation is about, is objective, the responsibility of the auditor when it comes to written representation, responsibility of management, the form and content of it, what you expect to see in written representation. And in situations where management refuses to provide written representation, what the auditor should do. So for those who have just joined, we've just looked at ISA 580, which is on written representation. And like I said, what we are looking tonight is the stage where the auditor is wrapping up the audit finalization. He has done all he needs to do. Now he's collating, he's preparing to write his audit report. And we said that there are standards that speaks to that. The first standard that speaks to this closing stage is ISA 580, written representation, which we've just discussed. Now, the second standard that speaks to audit finalization is ISA 450. ISA 450. And ISA 450 has to do with evaluation of misstatement. Evaluation of misstatement. Evaluation of misstatement is a 450. Now, if I may ask, what are misstatement? I think that's a good question to ask. So who is answering? Honora Emmanuel, can you quickly tell us what you understand by misstatement? We've been saying it over and over. If you have been in this class for a while, you hear misstatement. So what are misstatement? Who is answering? Is there anybody answering? Adeshwa.
Sir?
So I'm asking, what do you understand by the word misstatement?
Misstatement.
Yes. Hello, I can't hear you. Are you answering?
Yes, sir.
Okay.
Misstatement.
Yeah. What do you understand by the word misstatement in audit? When we say misstatement.
I don't understand it in that essence, sir. In audit today.
So what do you understand by it generally?
Misstatement in error now in putting down reports. Maybe
So it's the same thing when it comes to audit. Misstatements are
okay.
errors. They are errors, they are omission, they are incorrect, they are, how will I say, figures that are not correct or they are stated wrongly. It could also be misapplication of accounting policies. Now, the two major ways whereby you can have misstatement in a financial statement is either through errors or fraud. I don't know whether in this class the other lecturer have taken you guys on fraud and error. I believe he has. Misstatement can occur in financial statement either due to fraud or error. Now, if it's errors, error can either be due to omission or errors of commission. That means wrong application of accounting principles or accounting policies. You are supposed to do your debit and corresponding credit in different transactions. You only do the debit side, you don't do the credit side. Or you debit the appropriate leg and you credit a wrong transaction. Those are errors. Now, the difference between error and fraud is that errors are usually unintentional, while fraud are intentional. So fraud are intentional acts to falsify the figures of the financial statement. It could be deliberate act to use a wrong accounting policy. It could also be misappropriation of asset and you record it wrongly in the financial statement. The underlying difference between fraud and error is that fraud is intentional and error is unintentional. But the interesting thing between the two is that the effect of fraud or error on the financial statement will look the same. If there is an omission of 10 million on the financial statement due to error, and if there is a fraud of 10 million that is not captured in the financial statement, both will look the same. So both are called misstatement. Now, what the auditor needs to do, or what the auditor is trying to do, is to identify misstatement. And in identifying misstatement for the auditor is concerned about material misstatement. When we use the word material in audit or in accounting, it means significant. Something that when you say something is material, it means that the omission or the inclusion of that thing, when you remove that figure from the financial statement, it can affect the decisions of the user of financial statement. And that's why in audit, the auditor will set materiality based on the value of the company. So when we talk about misstatement, the auditor will have come across different misstatement in the course of the audit. So the standard that guides the auditor on misstatement is ISA 450. And this is called evaluation of misstatement. The real name is evaluation of misstatement identified during the audit. So when the auditor is carrying out the auditor will be documenting all misstatement that is coming in contact with. There are some misstatements that it will take to management. This thing is wrongly applied. Please correct it. Based on the materiality, oh, this one needs to be adjusted. Now, there are some that the management will not correct. They will either say it's immaterial. They will say, this one is for whatever reason. So for all those incorrect material misstatement, the auditor needs to get a written representation for them. We've discussed about written representation. So it means for all uncorrected misstatement, the auditor should obtain a letter of representation from management. So he will not only collate them, he will also obtain a letter of representation as to why they are not corrected, and he will attach them to the list of misstatement. Now, that's the objective of ISA 450. And it's broken down for the auditor that these are the things the auditor should do with misstatement. Number one is to accumulate all misstatement found during the audit. So anytime it comes across misstatement, you document it, list it, except if the misstatement is clearly trivial. Maybe there is an error of 2 kobo, or the error is 0.1 kobo when you look. But all misstatements should be accumulated. He will look at it, he will document it, he will list it. Now, it's not just only listing it. There is something called materiality, and there is something called performance materiality. So the auditor will look at the total of all misstatements that he has identified. That means he will sum them up and look at them. Does the total, is it close to the materiality threshold they are set? So, or is it near, or is it even material? So if I have a misstatement of 20 naira here, misstatement of 100 naira there, misstatement of 50 naira there, different misstatement in different part of the financial statement, and the materiality set for the financial statement is 500 naira. After identifying all these misstatements, the standard is at 450 says the auditor should look at the total of all the misstatements. Is it close to 500 naira, or even is it 500 naira? So if the total of the misstatement is close to the materiality set, or is even above it, or is just it, the auditor will need to look at whether he should adjust or revise his audit strategy. So the first thing the standard says is that the auditor should accumulate all misstatement found in the audit. The second thing looks at the total. Taken together, is it close to materiality or is it material? If it's material, the auditor will look at his audit strategy again, that it needs to be revised. Don't forget, at this stage, he's rounding up his work. So when he now discover that there are too many misstatements that might be material, he needs to go back and look at the strategy he has employed in the audit, or even the audit plan, and say, I need to revise, I need to adjust, I need to set a new materiality, or I need to obtain more evidence, and all of that. So that's the second, is the standard stage. Now, the third thing the standard is saying when it comes to evaluation of misstatement based on ISA 450 is that all these misstatements that the auditors have identified, all these misstatements that the auditors have looked at their total, it should communicate it to an appropriate level of management and request that they should be corrected. So is one thing to accumulate and list all misstatements. Is another thing to look at the total of misstatement, whether it's material. The third thing the standard is saying is that it should communicate all those misstatements to appropriate level of management. What do we mean by appropriate higher level of management? That means if the misstatements were found in, let's say, finance department or treasury, they are found in treasury unit of the finance department, he will communicate it not to head of treasury, but rather to head of finance. If it's a general misstatement that covers finance department, he will communicate it to the CFO, not the head of finance. That's what we mean by appropriate higher level of management. Now, if this misstatement is something that the CFO might be a bit reluctant to change it, he should communicate it to the audit committee. So in communicating misstatement, it should be to higher level of management. Now then, after communicating it to management, you should expect them to correct this misstatement. So based on that, these are the steps that ISA 450 require the auditor to do when it comes to misstatement. Now, quickly, let's look at overall view of the financial review of the financial statement. Now, when the auditor has finished work and is rounding up, we said that at this audit finalization stage, the audit work has been finished. So the auditor is demanding for written representation from management, which is ISA 50, is looking at misstatement, all uncorrected misstatement, and is trying to tell management to correct it. So this is the stage you will now look at the financial statement as a whole and carry out a final review of the financial statement. So the review is going to carry out on the financial statement. The final overall review is broken down into two. So there are two reviews you will conduct at this stage. The first one is general review of the financial statement. At this general review level, it will check that a clear conclusion has been reached on all the documented areas of the financial statement. So he's looking at every area of the financial statement. Oh, okay, what are the issues here? I have reached a conclusion with management. He's looking at all the financial statement as a whole, whether this draft financial statement by management makes sense or not. So that general review is on all the financial statement, every area of the financial statement. That's, you would look at the financial statement, look at the information. Oh, this draft financial, okay, everything, asset part, the liability. So that's the general review. Then there is a second one called specific review. Now, this specific review, what the auditor is looking at is, number one, compliance by the client with relevant accounting framework. The first one is just looking at the area, the financial statement, the figures, oh, everything mass, the financial statement makes sense, oh, inventory. Now, this one is taking a detailed and specific look on whether that financial statement is in compliance with the accounting framework that speaks to preparation of financial statement in that entity. Take, for instance, in Nigeria, we use IFRS. In US, is GAAP. So the auditor, when he's doing a specific review, after he's looking at what does the law of the land says when it comes to financial statement. If it's it could be comma, looking at company law. There are specific company law requirements for different industry on preparation of financial statement. So the accountant is looking at, oh, this is a banking, our client is into banking. What does the CBN regulation says when it comes to financial statement? What appropriate disclosure should have been made when it comes to this particular industry. So it's looking at compliance. It's not just for IFRS alone. The national legislation that speaks to, there are some FRCN requirements for some industry. The accountant, the auditor is looking at it specifically. Then the other thing the auditor will be looking at specifically is the accounting policy of the company. Now, accounting policy, when it comes to IAS 8, changes in accounting policies, there are guides and steps to how accounting policies should be applied. How accounting policies should, when you change accounting policies. So the auditor will be looking at whether the accounting policy adopted by the entity is acceptable, whether it's even in line with standard and industry practice. There are some accounting policies that is expected that once you're in that industry, you have to use it. Then if you want to change a accounting policy, there are some requirements. So the auditor will be reviewing the financial statement, whether the accounting policy adopted by the entity makes sense. So this is different from the figure analysis and looking at financial. This is on what accounting policies basis is this prepared. Then you will also be looking at the disclosure. Have they made relevant disclosure? There are some disclosure around non-adjusting event, disclosure around related parties. Some industries have ESG disclosure. So the auditor needs to review all of that. Then lastly, there are some business information that the client should disclose. So the auditor is carrying out an assessment of those information, whether they've been disclosed and whether they are in line with business practices. So this is an overall review that the auditor should carry out at this stage of audit finalization. He will look at the financial statement as a whole, look at whether the financial statement makes sense, carry out analytical procedure. When we say the financial statement makes sense, if you take a financial statement, there are gross profit margin. Does the gross profit margin, when you carry out analytical procedure, is it in line with what it should be? Oh, your gross profit for the last 3 years has been 20%, gross profit margin, 20%. Why is it suddenly 50%? Or why is it suddenly 5%? He has to look at that. Oh, your revenue, what has changed? Why is your revenue not moving accordingly? Oh, your expenses. He has to look at it in relation to other financial statements, comparative analysis. Then you also look at it in line with the industry. Or when you benchmark this financial statement against other competitors or other business in this, does it make sense? That's what we mean by general review. Because it's one thing for financial statement to be prepared. It's another thing for it to make sense, because these are what investors are looking at. Oh, how come the financial statement of this particular company in the whole of the industry is the one making 100% return? So those are the things the auditor will look at generally. But specifically, is looking at the accounting framework that the client is using. Has the financial statement been prepared in line with regulatory standard? Does it have the relevant accounting standard? Is it in line? Is looking at the accounting policy. Is looking at appropriate disclosure. Those are specific review. Now, after this overall review of the financial statement, after evaluation of the statement, after obtaining the written representation from management, then the auditor can prepare his audit report. Now, in preparing the audit report, just like I said that there are standards that guide the audit work. There are about 4 standards that speaks to preparation of audit report. Now, 2 of those standards are covered in your syllabus. That's ISA 700 and ISA 701. In your pack, I'm not sure it's stated there as 7. ISA 700 is the auditor's report on financial statement. Then please write this in your pack or write it in your note. ISA 701, key audit matters in the independent audit report. Is not in the pack. So in case you'll be saying, they didn't tell us so. There are 4 standards when it comes to the audit report. The first one is a 700, the audit report on financial statement. The second one is ISA 701, key audit matters in the independent audit report. While the third one is 705, modification to the opinion in the independent audit report. Then the other one is ISA 706, emphasis of matter paragraphs and other paragraphs in the independent report. For your syllabus, we'll be looking at ISA 700, the audit reports on financial statement. Then ISA 701, key audit matters in the independent report. Now, but before we look at the audit report, quickly let's talk about the expectation gap. The expectation gap. What do we mean by expectation gap? And what is the effect of the expectation gap? Now, expectation gap simply means the, in audit, most of the time when you hear people talk about auditors, they say, they want to catch thief. They are looking for what is not lost. This, that. This auditor self, what is they find self, all of that. Now, that's the expectation gap. What people thinks about auditor and what actually the auditor should do. So the expectation gap is simply defined as what the public thinks the auditor should do and what the auditor is expected to do based on the regulations and standard. So the difference between the two, that's what we call expectation gap. So on one hand, the public is thinking something else about the auditor's work. Meanwhile, this is what the auditor is required to do based on regulation, based on the profession. So the difference between the two is what we call expectation gap. So the public believes that the audit opinion in the audit report is a certificate. So once they see audit report, that means once the opinion of the audit in the audit report, that's like a stamp that everything, that the financial statement is fine. You can rely on it. But don't forget, the auditor have used sampling. So the fact that there is an audit report that is giving an unqualified opinion is only saying that that financial statement has been prepared in line with applicable financial statement. That financial statement is free from material misstatement. It's not saying it's not free from misstatement. That financial statement shows a true and fair view. It might be showing a true and fair view and the company is not making profit. A financial statement that where the income statement is showing loss, that the company is making loss, the audit opinion can still be an unmodified opinion, meaning that it will say that the financial statement is prepared well, the financial statement is a true and fair view, the financial statement is free from material misstatement, but the company is not making profit. But some people probably believe that that financial statement is audited. What is the content of the financial statement? The company might be struggling and the financial statement is well prepared. So, but the public believes that once you have an audit report and the opinion is there, that's like a certificate that the company is doing fine. That's an expectation gap. The public also believes that the auditor has a duty to prevent and deter fraud. So some people believe that once an auditor has come in to audit a company, then the auditor should discover all fraud that has happened, should detect it, and that the auditor should even be the one preventing fraud. The reason for the audit, even though in an audit, fraud that has been committed by entities should be discovered, especially when it has implication for the audit, the responsibility for prevention and detecting fraud lies with management. Even though in carrying out a thorough audit, the auditor would discover fraud, but the primary function for detection and prevention of fraud lies with management. So, but public believe that, then the other thing is that the public assume that when auditors carry out their work, they've tested all transactions 100%. But you and I know that auditors carry out only audit sampling. They don't test all transactions because if they should, then the audit will not finish. Take, for instance, some holding companies that are very big. So, but these are the things that the public believes that the auditors have come to do. Now, based on all this expectation gap, it creates liability for the auditor. And there are three main liabilities that is as a result of this expectation gap. I've said that the expectation gap is what the public believes the auditor should do as against what the auditor is required to do based on the profession. So the public is thinking this, meanwhile the auditor is doing this. So this gap creates three, or is expressed in three main ways. Now, I'm not sure if this is in your pack. Okay, let me see. I don't think it's there, but just write it somewhere. The first element, or the first way this gap is manifested, is what is called standard gap. Standard gap. The second one is performance gap. And the third one is liability gap. Now, these are all forms of expectation gap. Even though we've said that the expectation gap is what the public thinks the auditor should do as against what the auditor is required to do, the way you see it is the first one, standard gap. Now, this standard gap is the one that the public has a perception that audit standards are all encompassing, that the audit standard covers everything in the audit. But audit standards are not, most of the audit standards are like principles to follow. They don't cover all situations. They are more like guide. So, but the public believe that, there are standards for everything. So that creates what is called standard gap. Standard gap. Now, the second one is performance gap. Now, the performance gap occurs because the public believe that there is nothing to audit work, that the audit work is just because of is required by law, that the audit work doesn't have time, the performance of audit work is not there. So they are not expecting much from the audit work because they don't believe that the audit work is up to standard, is that the performance of auditors has dropped. The auditors are not doing anything, they are just coming to check audit evidence. So there is called performance gap, that the audit work has fallen below standard, that we are just doing audit because they require us to. So that's the second one, performance gap. Why the last one is liability gap. Now, this liability gap is as a result of when companies fail and people believe that auditors are responsible. So they believe that anytime a company is audited and there is the financial statement has been audited by an auditor, if the company should go down or there is a problem, then let's go for the auditor's neck. That's the liability gap. Any questions so far before we continue? I know that this part is not fully explained in your text, but I just picked it from ICAN pack so that you can never know. Any question before we go on? Okay. If you don't have question, I have question. Are we saying that all is clear? So I want to ask a question. Sekinat Akimbade, are you there?
Sir.
Okay, hello.
Hello,
I'm
sir.
listening. Yes. Ask your question. Hello. Who is?
Sir, my question is on this forms of expectation gap.
Okay.
That is what the general public
Thanks.
expects an auditor to do, and then what the regulation
Auditor, yeah, what the profession
is
and the
expected of
regulation.
auditor. Now, my question is how
I'm listening.
yes, require auditor to do. My question is how will an auditor measure up balance, attain balance in these two expectations, that of the profession and the regulation, and that of the general public?
Okay. That's a good question. Actually, This topic is covering advanced audit and assurance, but I guess I can just put it in your pack for introduction. But nevertheless, it's good that you ask the question and you be aware. Now, if you look, this topic is actually a full topic in advanced class, but let me just try and answer your question. Now, I said this expectation gap is the difference between what the public thinks the auditor should do and what the auditor is required to do based on regulations and profession. So on one hand, we have the public thinking this is the auditor's work, while on the other hand, the regulation and profession have stated what the auditor work is. And that's why it manifested itself in this trigger. Now, your question is, how should the auditor balance what regulation and profession say it should do and what the public is thinking it should do? Am I right? Now, when you get to the advanced class, there is another part of this topic that is not covered here. That's what is called closing the expectation gap. So how the expectation gap should be closed. So what we're saying is that this expectation gap is not just something we just know and go away. No, there is a third part to it, which is closing the expectation gap. Now, to close this expectation gap, because once the expectation gap is narrowed or closed, then the auditor doesn't have problem. So the first thing closing the expectation gap is that the responsibility for closing the expectation gap lies with the regulatory and professional body that oversees the work of the auditor. So there is that on one hand. So because the regulators, FRCN, ICAN, different accounting body, they are the ones that have set the work of the auditor. They are the ones that issue licenses. So the first thing is that they are the ones to do more in closing the expectation gap. And how should they close it? Number one, there should be public seminars and forums whereby enlightenment will be given on what the work of the auditor is. So what we're saying is that regulatory bodies, national bodies should carry out more public seminars, more enlightenment program to enlighten the public about the work of the auditor. That's the first thing. Then the second thing is that the regulatory body should also carry out a monitoring and controlling activity over the work of the auditor. So I've started with saying that in closing the expectation gap, the responsibility lies with the regulators. So it's not the auditor that will be going about trying to enlighten his client that, see, this is what I'm supposed to do. Although there is a bit of that, but the major work of closing that gap lies with regulatory bodies. So ICAN as a regulatory body in Nigeria should carry out more public fora, carry out more seminars to enlighten public on what the work of the auditor should do. That's the first thing. Then the second thing, ICAN, FRCN should carry out more monitoring and assessment of the work of the auditor. So when the clients and the public knows that anytime an audit or an audit firm is carrying out an audit, that work will be monitored by the oversight bodies. So everybody knows that at a point in time, ICAN is going around audit firm, monitoring and checking their work. That will also help in closing the gap. So these are two major ways of closing that gap. So the auditor itself doesn't need to do much other than expect the regulatory to do that. So when the auditor comes in contact with client, he can only do so much like, set out my work. They are on the part of the auditor, the way, because there is a regulatory part, the way the auditor now will need to close this expectation gap is that at the outset of the audit or the onset of the audit, that's why that topic, if you've forgotten it during your revision, go and read it again. Obtaining an audit engagement. When an auditor is about to commence or obtain any audit work, there is what is called letter of engagement, the engagement letter. In that letter of engagement, The responsibility of the auditor should be clearly stated. The areas covered by the audit should be stated. The materiality to be used should be stated. The sampling method, that this audit will be based on sampling, will be stated. So at the point of obtaining any audit engagement, the letter of engagement is very critical. Is where the auditor will state his responsibilities, is responsibility for the auditor, the way the audit work will be done, all the expectation around the audit will be clearly stated. So enlightenment will start from the beginning of the audit. So if a client has called in for an auditor to come and do the audit work, the auditor should ensure that the content of the letter of engagement is clearly understood by the client. So that's how the auditor tries to close the expectation gap on his part. But the larger work is from the regulatory body. Do I answer your questions, Joseph?
Thank you very much. Thank you very much.
Okay. So now, if there is no other question, we will go on. I wanted to ask a question before, but I'm looking at the time. So quickly, we'll look at the unmodified audit report. Now, just to reiterate and recap, I said what we are looking at today is the audit finalization and reporting. So this is the stage where the audit is gradually coming to an end. The auditor is trying to wrap up the audit. And you said that at this stage, he has finished the audit work, but he's trying to prepare the audit report where he will express the audit opinion. Now, we said that at this stage, there are standards that speak to how the work should be, the finalization of the audit should be. The first standard is ISA 580, which is on written representation. And we say written representation are written statement from the audit, from management on certain areas that need clarity by the auditor, or on as a support to the audit evidence. So written representations are statements backing or supporting the audit evidence that the auditors have obtained, or just to give clarity on some areas of the audit. And we've also said that there are forms and content, some things that should be in written representation. We said that the written representation should speak to the audit. It should contain the responsibilities of management when it comes to preparation of financial statement. It should also speak to the fact that they've applied the appropriate standard and all of that. And we also look at ISA 450, evaluation misstatement, identified during the audit, that in the course of the audit, the auditor will have obtained different misstatements. We've tried to explain what misstatements are, and that the auditor will collate all these misstatements, look at the impact of the misstatement on its materiality. Are they close to it? Can they be material? And demand that management should correct them. Now, if management correct them, fine. If they don't correct them, there are appropriate action. It should report to higher level of management. Then we now looked at the overall review of the financial statement. We said there are two major ways that the auditor reviewed the financial statement. There is the general review, looking at the financial statement, the figures on it, whether they make sense, using analytical procedure, comparison. Then there is the specific review on what accounting policies have been used, the estimate and all of that. Then we also said that there are the audit report, the standard that guides audit report, which is what we want to look at, is ISA 700 and ISA 701. ISA 700 is on the unmodified audit report. Then we said before we look at the audit report itself, there is what is called expectation gap. An expectation gap is what the public thinks the auditor should do and what the auditor is actually required to do. That this expectation gap can be in three forms: standard gap, performance gap, liability gap. And I said that actually this topic, expectation gap, is testable in advanced audit and assurance, but ICAN has put a bit of it here. Then someone has a question: what is the role of the auditor in closing the expectation gap? And I've explained that the role lies majorly with regulatory body. When it comes to the auditor, the letter of engagement is a means of putting clarity to what the audit should be. So now we are looking at the ISA 700. Now, ISA 700 is an unmodified audit report. When you hear the word unmodified, what comes to your mind? Unmodified. Now, ISA 700 is on the audit report that has been prepared. And there are, like I said, four standards that covers the audit report. The first one is the audit report that is unmodified, which is ISA 700. Then there is 701, key audit matters in the audit report. The remaining two are tested in your professional level. 705, modification to opinion, and 706, emphasis of other matter. Now, 700 is looking at unmodified report. An unmodified report, I'm not telling you what unmodified report means. An unmodified audit report is an audit report containing an audit opinion, not modified in any way, either by changing the unmodified to a qualified opinion, advice opinion, or a disclaimer of opinion. What we are saying is that this report, there is no modification of any sort by the auditor. So the auditor is not modifying the report due to a disclaimer. It's not modifying the report due to an adverse opinion or adverse report or anything. It's just giving the opinion clearly. An unmodified report, it could be that it didn't modify the report by adding any extra paragraph. So in an unmodified audit report, there is no emphasis of matter paragraph, there is no other matters paragraph, it's just the opinion paragraph. So ISA 700 is what covers an unmodified audit report. So this report contains an opinion that the auditor has not modified in any way. Now, the objective of ISA 700 is that the auditor forms an opinion on the financial statement based on the evaluation of the conclusion drawn from the audit evidence. So he looks at the audit evidence and he forms his opinion. And he expressed that opinion clearly through a written report that describes basis for that opinion. So the unmodified report, when it comes to ISA 700, is based on the auditor have obtained audit evidence and he forms the opinion based on the audit evidence and he expresses it on the basis of opinion paragraph. There is no modification. The level of assurance of one modified report is a high level of assurance. An unmodified opinion gives a high level of assurance. So an example of unmodified opinion could be, in our opinion, the financial statement shows a true and fair view, and the financial statement has been prepared in line with applicable financial framework. An example could be, in our opinion, the financial statement does not show a true and fair view, and the financial statement has not been prepared in line with applicable. So it could either be for or against. But what we are saying is that based on the audit evidence obtained, the auditor just expressed this opinion. And in reaching this type of opinion, the auditor is required to evaluate whether he has obtained sufficient and appropriate audit evidence, whether the financial statements are free from material misstatement or not, whether all uncorrected misstatements, they are material or not, whether the financial statement has been prepared in line with applicable financial framework. So that's the basis for reaching this type of opinion. He will first check that he has enough sufficient appropriate evidence to form the opinion. The financial statement, they are free from material misstatement or not. All uncorrected misstatement, they are material or they are not. The financial statement has been prepared in line with applicable financial framework. You look at that. The financial statement refers to applicable financial statement. The accounting state estimates, they are reasonable. The accounting policy apply, they are consistent and appropriate. The information in the financial statement is relevant. So these are the things that the auditors will look in forming an unmodified opinion. So he will look at it. He has obtained sufficient appropriate evidence. There is uncorrected misstatement. Uncorrected misstatement are either they are material or not. The financial statement has been prepared in line with applicable financial framework. The accounting policies used, they are appropriate. The accounting estimates are reasonable. The financial statement is relevant, is reliable. These are the things that the auditors will look at before forming an unmodified financial audit opinion. Now, when you look at an unmodified audit opinion, what are the elements or what are the things you want to see? So when you pick an audit report that is unmodified, these are the content of an audit report that is unmodified according to ISA 700. I've said there are 4 standards that guide the audit report. The first one is the unmodified audit report, which is ISA 700, which is what we are looking at. The second one is an audit report containing key audit matters. The third one is audit report with emphasis, with modification to the opinion. And that's what you call a modified audit report. While the fourth one is emphasis of matter paragraph and other paragraph in the audit opinion. So the first one is what you call unqualified audit opinion. Same thing as unmodified. The second one, audit report that has key audit matters. The third one, audit report that has a modified opinion. Then the fourth one, audit reports that have emphasis of matters paragraph or other matters paragraph. Now we are looking at ISA 700, the unmodified audit report, and what is the content of that? So any report that is unmodified, these are the things you will see there. Number 1, title. Number 2, the addressee. When we say title, there will be a title of that report. The title of report speaks to, this is the audit report for so, 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 and so. So that will be clearly stated in the audit report. Then there will also be the addressee. The report will be addressed to a particular client. It will be stated in that report. Then there will be the introductory paragraph. Then under that, there will be the audit opinion. So there will be a place there that it will be stated, this is the opinion of the auditor. The basis of that audit opinion will be stated. The statement of management responsibility for the financial statement will be stated. So management responsibility will be stated as well as the auditor responsibility. Then the other responsibilities of other reporting responsibility. These are the other people that are responsible for this, maybe audit committee, board of director, shareholders. Then the name of the engagement partner and signature, then the auditor's address, the date, and that's it. So whichever way you're going, some text in your text material, you have it as 10. In ICAN is 14. But when you look at the 14 item list in ICAN and the one listed in your material, is more or less the same. So if you are in doubt, I can read out the ICAN one for you so that there is no doubt, but it's more or less like the same. In your text material, you have title, addressee, introductory paragraph, statement of management responsibility for financial statement, the auditor's responsibility, the auditor's opinion, other reporting responsibility, if there are audit committee, board of director, auditor signature, and date of audit report and audit address. But when you look at ICAN part, we have it as 14. And in the ICAN part, now listen, the ICAN part has title, addressee, audit opinion, basis for the opinion, going concern material uncertainty if applicable. Now, it's if applicable that you see in ICAN, and that's why it's not put in your test. Key audit matters should not be here because they put it as if applicable. Now, once you have key audit matter, it speaks to ISA 701. So for those of you reading ICAN Pack, that's why we're trying to differentiate between what ICAN have stated and what we have in the test. The other information, if applicable. So if you look at the if applicable in this ICAN Pack, there are about 4. By the time you remove the 4, you find out that it will come back to 10. So that's what we're saying. Now, that's how the ISA 700 will look like. Don't forget, the ISA 700 speaks to unmodified opinion. And we said that unmodified opinion contains an opinion that is not modified in any way, either by changing the opinion to anything. There is no extra paragraph. There is no emphasis of matter paragraph. The opinion just comes directly from the audit evidence that has been obtained by the auditor. So that's the basis for unmodified. Now, when you come to the last standard for today, which speaks to audit report, which is ISA 700. Okay, your test material is now having ISA 700. So quickly, let me just go over ISA 700 so that you won't say, they didn't teach us that one. No. It's not in your material, but it's in your ICAN pack, and I've prepared that I will speak about it. So the last standard we'll look at today, which speaks to audit report, is ISA 700. Now, ISA 700 is an audit report that has key audit matters. ISA 700 speaks to audit report that has key audit matters. Now, there are some audit that the auditors have carried out, and there are some areas in the audit that he wants to draw attention to. So ISA 700 is communicating key audit matters to the client. So it's a standard that was introduced in 2015, and that's why sometimes some people don't put it here, but it's testable now. So key audit matters must be communicated to all lists. You usually see this type of audit report for listed companies. So it is required that the auditor should communicate the key audit matters in his audit report. So, and what is the definition for key audit matters? According to ISA 700, if you are writing, you can write, key audit matters are those matters that in the auditor's professional judgment were most significant in the audit of the financial statement of the current period. So these are areas of most significant. So the auditor, during the course of the audit, noticed that this area, inventory, very significant. Cash and bank balances, significant. Asset valuation, significant. So based on that, ISA 700 expect the auditors to communicate all these significant areas in his audit report. That means it should state them. So the followings are to be noted when it comes to key audit matter. Number one, the key audit matters should be defined by the auditors, not by the user. That means it's the auditor that will say that this area, they are significant. It's not that the client that will come and say, these are significant area. No. The key audit matters are standard element of unmodified report. Now, the fact that a report is unmodified based on ISA 700, there can be some areas that the auditor wants to draw attention to because they are significant. So the moment an audit report, an auditor is drawing attention to any areas and is calling it key matters, then it changes the report from 700 to 701. So the standard is saying that once a report has key audit matters, then it's no longer ISA 700 objective, because ISA 700 is unmodified report. There is no special paragraph. There is no extra paragraph. But once you have a paragraph that is key audit matters, is a 700 that apply. And it doesn't mean that the opinion has been modified. It only means that the auditor is stating some areas of significance for the users of the financial statement. So you don't have to modify the opinions, but you are drawing attentions to these key areas in the audit. Now, what are those significant areas? They can be areas of high risk. So when the auditor is carrying out the audit, notice that these are high risk area. There could be material misstatement around this area. So the auditor wants to draw attention to it. It could be area of where the auditor feel that management have used their judgment. Oh, accounting estimate, provisions, and contingent liability. I said last week you guys should read about contingent liabilities, financial statement as action. So the auditor wants to draw attention to area where managements have used their judgment. So usually of area of estimate, then the auditor also wants to draw attention of the users of the financial statement to significant transaction. Maybe in the financial statement, the entity purchased a landed property or they have an investment in a new line of business. The auditor wants to draw attention to this area. So that's the standard that speaks to when the paragraph is on key audit matters. It doesn't mean the opinion has been modified. It's still an unmodified opinion. It just want to draw attention to this. So when you look at the core element of audit report for ISA 700, just like it is for unmodified, the only difference is there will not be key audit matters paragraph. It will be included there. So after you have your title, address, introductory paragraph, management's responsibility, auditor's responsibility, auditor's opinion, basis of that opinion, you will now have key audit matters. So that area will speak to the areas of significant area that are of significance that the auditor wants to draw attention to. That's simply the difference between 701 and 700. It's a 700 is on unmodified opinion, unmodified report. 701 is audit report with key audit matters. And this is where we call it a day for this evening. But before we go, let me quickly do a recap. I said today we'll look at audit, finalization, and report, and we'll look at standard that speaks to how the audit is being drawn to a close, what the auditor should do when he's about to prepare his audit report. We look about 4 standards. The first one was ISA 580, written representations. Written representations are documentation or written statement from management to confirm certain matter or support an audit evidence. So the auditors needs to get written representation, written statement, documentation from management on some areas of the audit, maybe for clarity purpose. He might have obtained a verbal confirmation or verbal explanation, but as he's rounding up his audit, he needs to get a written statement from management. Now, it could be to support audit evidence. Then when he finishes the audit, he needs this written representation on the whole audit itself. And that speaks to the form and content of that letter. That the letter will speak to the audit in question. The letter will speak that management have done their responsibility in preparing financial statement. They will state that all related party transactions and relationships have been disclosed. They will say that they've provided the audit with all relevant material. They will say that, okay, when it comes to fraud and suspected fraud, this and this have been done. They will state all of that. And we say, what if management is not providing this? Said the auditor should discuss with management, appropriate level of management or those charged with governance. Then the auditor should also reevaluate the integrity of management if they say they are not providing it. Then you should also look at taking appropriate action as far as the effect it might have on the audit report. Then we look at ISA 450, evaluation of material misstatement. That what are misstatement? We said that misstatement are errors, they are fraud, they're anything that is not correct that is not right or anything that is wrongly stated in the financial statement. It could be due to error or fraud. That what the auditor should do is that identify all misstatement, all uncorrected misstatement, aggregate all of them and look at whether they approach materiality and communicate them to management to correct. From looking at evaluation method, we look at the overall review of financial statement. We said there are general review and specific review. Then we also look at audit report 700 and 701. Now, I have past questions that speaks to this topic. This topic we just finished. So I'll be dropping them on the WhatsApp group. But before then, if you just have your note, just take them down. The past question for this topic is get your Pathfinder November 2021, November 2022, May 2023, and May 2024. Now, if you look at these questions, you can see that they are testing this question as recent as May 2024. I don't have the past question of November 2024, but I believe they must have tested something like this. So I'll be dropping the past question in the WhatsApp group. Please, let's try and attend to it and let's try them. This will be the last topic I'm taking you guys for this diet. I'm a WhatsApp away. If you have any questions, you have any clarity, just send a WhatsApp to me and I will respond appropriately. Any question before we go this night? So I'm dropping the question now on the group. So before we go, hold on, let me just put all the questions. While I'm doing that, if you have questions, just please ask now. Don't get to the exam and say, I should have asked that question. Is anybody asking question? If there are none, so do have a good evening. But please check the WhatsApp group for the question. Past question, November 2021, question 1. That was even a 30-mark question. Then we also have it November 2022, question 6. We also have May 2023, question 1 again. So you see this question, this topic is not a topic to be played with. I will advise that you still go over it again. May 2024, actually 2 questions, this past question, question 3 and question 7. So I've dropped the questions on the class, on the WhatsApp group. Please, let's look at it. If there are no questions, good evening and do have a good night rest.
Thank you, sir.
Hello. Okay, you're welcome.
All right, thank you, sir.
You guys were just quiet. You were not asking questions. Please, I'm still WhatsApp away. If you have questions in the course of the week, don't hesitate to reach out.
Okay, sir.
Oh yeah. Good night, everyone.
Good night, sir.
Okay. So the past questions are on the group. Somebody, please, can you come again on the past question? We have November 2021, question 1. I'll write it on the chat.
I got them already. Thank you, boss. Thanks, sir.
Okay.
Yes, I got it this time around. Spoke. Thanks.
Okay, all right. So good night, everyone. Have a good
night,
night.
sir.